Disclaimer. Disclaimer.
AG here, and I've spent the last 72 hours watching silver have what can only be described as a very public breakdown, the kind that makes your retirement account nervous and Wall Street traders reach for the antacids. Now, I'm usually the guy telling you to stay calm during market chaos, but when 3 mechanical kill switches activate simultaneously with a 21-day countdown clock, we need to talk. Pop quiz. What happens when a precious metal hits an all-time high of $86.62 per ounce, then crashes 15% in less than 2 weeks? If you're thinking normal market correction, you're missing the most important financial story unfolding right now, because this wasn't just a pullback. This was a coordinated mechanical massacre that's only in its first act. And what happens in the next 21 days could determine whether silver becomes the trade of the decade or a trap that swallows billions. December 27th, 2024. Silver touches a record high that most analysts thought impossible just 6 months earlier. Champagne corks are popping in trading rooms from New York to Singapore. Then something interesting happens, something that should make every American investor sit up and pay attention. Within 72 hours, the Chicago Mercantile Exchange issues advisory number 25-393, raising margin requirements on silver futures from $22,000 to $25,000 per contract. Think about what that means for a moment. You're a trader holding 10 silver contracts, confident in your position after months of steady gains. Suddenly, you need to come up with an extra $30,000 in cash. Not next week, not tomorrow, but immediately. Can't post the margin? Your broker liquidates your position whether you like it or not. That's exactly what happened to thousands of traders holding positions worth billions of dollars. But here's where the story gets darker. The CME doesn't just hike margins once and walk away. 7 days after the first increase, they do it again. According to CME Group's own documentation, this pattern of rapid-fire margin increases has only happened twice before in silver's modern history. Once in 1980 during the Hunt Brothers collapse, and again in 2011 when silver crashed from nearly $50 to $26 in 5 weeks. Both times, these margin hikes preceded devastating liquidation cascades that wiped out fortunes. Wall Street calls this risk management. Experienced traders call it something else entirely. A mechanical kill switch designed to flush out over-leveraged positions and reset the market. The math is brutal and beautiful in its simplicity. Force traders to post more cash, watch them scramble to meet margin calls, then systematically liquidate those who can't. The selling pressure feeds on itself. Prices drop further, triggering more margin calls, creating a downward spiral that can turn orderly markets into bloodbaths. By January 3rd, silver has surrendered all those euphoric gains from its record high, trading back down near $73. Mainstream financial media writes the predictable stories about profit-taking and overbought conditions. But while everyone focuses on the margin story playing out in Chicago, something far more significant is happening 8,000 miles away in Beijing, January 1st, 2026. While Americans are nursing New Year's hangovers, China quietly activates export licensing restrictions on refined silver. Not an outright ban, that would be too obvious, too provocative. Instead, they implement a licensing system that adds friction, delays, and uncertainty to every ounce of Chinese silver trying to reach global markets. The World Bureau of Metal Statistics reports that China produces approximately 4,000 metric tons of refined silver annually, representing roughly 15% of global supply. That's not just a footnote in some analyst report. That's the physical metal that feeds industrial demand from solar panels to electronics to medical devices. Here's what should grab our attention. According to CME delivery reports, COMEX silver inventories have been bleeding for 5 straight years, down 70% from their 2020 peaks. We're talking about warehouse stocks that once held over 400 million ounces, now sitting at barely 120 million. Meanwhile, the Silver Institute's latest survey shows industrial demand isn't slowing down, it's accelerating. The solar industry alone is projected to consume 450 million ounces by 2030, and that's before we factor in the electric vehicle revolution, 5G infrastructure build-out, and the dozens of other technologies that require silver's unique properties. So let me paint you a picture of what's really happening here. We've got a physical market running on fumes with inventories at decade lows. We've got China choking off refined supply at the source with new export restrictions. And we've got margin hikes forcing massive liquidations in the paper futures market. If you're thinking these 3 events happening simultaneously is just cosmic coincidence, I've got a bridge in Brooklyn to sell you. The data tells a story that should concern every American with exposure to precious metals. According to analysis from CPM Group, the gap between physical silver prices in Shanghai and paper silver prices on COMEX has widened to over $8 per ounce, the largest disconnect since the Hunt Brothers era in 1980. Think about what that means. In a properly functioning market, physical metal and paper contracts should trade at roughly the same price, maybe with a small premium for delivery costs. $8? That's not a premium, that's a scream from the physical market saying, we don't trust your paper anymore. Every time this Shanghai premium widens beyond $3 or $4, smart money starts paying attention because it signals that the paper market, where most price discovery happens, is losing its grip on reality. Physical buyers in Asia are essentially saying, we'll pay $8 over your COMEX price because we know the real metal is worth more than your futures contracts claim. That's not speculation, that's hard data from actual transactions in the world's largest physical silver market. Now, here's where your personal financial situation intersects with this global chess match. Maybe you own silver coins in a safe deposit box. Maybe you've got shares of a silver mining ETF in your retirement account. Maybe you're thinking about buying the dip after this 15% correction. Whatever your position, what happens in the next 3 weeks is not just another market fluctuation you can ignore. It's a convergence of mechanical forces that could redefine silver's trajectory for years, because everything I've just described, the margin hikes, the Chinese export restrictions, the inventory drawdown, the widening Shanghai premium, that's just the setup. The real danger zone starts on January 8th, less than a week from now. That's when the Bloomberg Commodity Index begins its quarterly rebalancing process. And according to JP Morgan's December 12th Commodity Strategy Report, this rebalancing could force passive index funds to dump over $5 billion worth of silver futures in just 5 trading days. Let me put that number in perspective for you. $5 billion represents somewhere between 9 and 13% of total open interest in COMEX silver futures. We're not talking about active traders making discretionary decisions based on market conditions. We're talking about passive funds that must mechanically reduce their silver exposure to match predetermined index weightings, regardless of price, regardless of fundamentals, regardless of whether it makes any logical sense. They have no choice. The index rules require it. Think about the timing here. Margin requirements just jumped, forcing leveraged traders to liquidate billions in positions. China just activated export restrictions, choking off physical supply. Inventories are already at decade lows. The physical to paper price gap is screaming that something's broken in the price discovery mechanism. And now, starting January 8th, passive funds must dump another $5 billion onto a market that's already reeling from forced selling. Wall Street has a term for this kind of setup, a perfect storm. But that phrase doesn't quite capture the mechanical precision of what's about to unfold. This is not random chaos. It's 3 distinct pressure waves converging on the same market at the same time, each one amplifying the others. The margin hikes create the initial selling pressure. The Chinese restrictions ensure physical buyers can't easily step in to absorb that selling. And the index rebalancing delivers the knockout punch right when the market is most vulnerable. Here's what keeps me up at night, and what should concern you. We've seen this playbook before. In 1980, when the Hunt brothers faced similar forced liquidation, silver collapsed from $50 to $10 in just 2 months. In 2011, when the CME raised margins 5 times in 9 days, silver crashed from $49 to $26 in 5 weeks. Both times, the combination of margin pressure and forced selling created cascades that overwhelmed any fundamental support. But, and this is crucial, both of those historical crashes happened in markets where industrial demand was relatively stable and inventories were abundant. Today's market is fundamentally different. According to the Silver Institute's World Silver Survey, we're facing structural deficits where industrial demand exceeds mine supply, and that gap is projected to widen through the rest of this decade. The solar industry's appetite for silver alone has grown from roughly 60 million ounces in 2020 to projections of over 200 million ounces by 2028. So here's the question that determines everything. When $5 billion in forced index selling hits a market with depleted inventories, elevated margins, and restricted Chinese exports, does the physical shortage create a floor that prevents a full collapse? Or does the mechanical selling pressure overwhelm even the strongest fundamental support, creating a capitulation that sends silver spiraling down to test the low 40s or even worse? The answer will be written in the price action between January 8th and January 21st, exactly 21 days from today. That's when the Bloomberg rebalancing window closes, when we'll know whether the physical market can absorb this mechanical selling wave. And when silver will either confirm a new base for the next major leg higher or break down in a way that resets the entire bull market narrative. This isn't about predicting the future or making guarantees about where silver trades next month. This is about understanding the mechanical forces at work in our financial markets, recognizing when multiple pressure points converge, and preparing for outcomes that most investors aren't even watching. Because in 21 days, we'll know whether this correction was a gift, a final shakeout before silver's true breakout, or whether it was the first warning sign of something far more painful. The clock is ticking, the pieces are in motion, and what happens next could reshape precious metals investing for the rest of this decade. Now, I know what some of you are thinking. AG, you're making this sound like some coordinated attack, but maybe it's just normal market mechanics doing their thing. Fair point. Let me show you the receipts, because the paper trail on this situation reads like a financial thriller, and every document I'm about to reference is publicly available if you know where to look. CME Group Advisory Number 25-393, published December 30th, 2024. It's a dry, technical document that most traders scroll past without much thought, but buried in that bureaucratic language is a blueprint we've seen exactly twice before in modern silver history, and both times it preceded absolute carnage. The advisory specifies that initial margin requirements for silver futures contracts increased from $22,000 to $25,000 per contract, effective immediately. Then, 7 days later, on January 6th, they bump it again. Here's why this matters beyond the obvious forced liquidation story. According to futures market research from Blue Line Futures, the average retail trader using standard 2-to-1 leverage would need to liquidate their position or inject additional capital within 48 hours of that first margin hike. For institutional players using 10-to-1 leverage or higher, and yes, they exist, the math becomes catastrophic. A trader holding 100 contracts suddenly needs to produce an extra $300,000 in cash. Can't do it? Your positions get sold at market, regardless of whether you're sitting on profits or losses. But let me take you back to the two other times we saw this exact playbook unfold, because the parallels are haunting. March 1980, right before Silver Thursday. The Hunt brothers, two billionaire siblings from Texas, had quietly accumulated somewhere around 100 million ounces of physical silver and controlled an estimated 60% of the entire futures market. They were convinced silver was heading to $300 per ounce. The COMEX, watching this concentration risk with increasing alarm, suddenly changed the rules mid-game. They issued what they called Silver Rule 7, which essentially banned new long positions and raised margin requirements repeatedly over several weeks. What happened next became financial legend. Forced to meet margin calls they couldn't cover, the Hunt brothers' positions imploded spectacularly. Silver crashed from $50.35 to $10.80 in just 8 weeks. Fortunes evaporated. Brokerage firms teetered on the edge of bankruptcy. The entire episode nearly triggered a systemic crisis that required emergency Federal Reserve intervention. The Hunts eventually settled with regulators, paying over $10 million in penalties and pleading no contest to charges related to their market manipulation. Fast forward to April 2011. Silver has been on an absolute tear, climbing from $18 in August 2010 to nearly $50 per ounce by late April 2011. Retail investors are piling in, convinced they've found the next big thing. Then the CME pulls the same move, 5 margin increases in just 9 trading days, each one jacking up the capital required to hold positions. According to Kitco News Archives, the margin requirement jumped from $14,000 per contract to $21,000 in less than 2 weeks. The result? Silver collapsed from $48 to $26 in 5 weeks, a 46% bloodbath that wiped out everyone who'd bought near the top. So when I see CME Advisory 25-393 implementing the same pattern, rapid margin increases during a parabolic move, every alarm bell in my head starts ringing. The playbook hasn't changed. What has changed, and this is absolutely critical, is the fundamental backdrop supporting silver prices today versus those historical episodes. In 1980, industrial demand for silver was relatively modest. Photography consumed massive amounts, but that was about it. By 2011, industrial applications had expanded, but nothing like what we're seeing now. According to the Silver Institute's World Silver Survey, 2024 industrial demand has become the dominant force in silver markets, and the solar industry alone is projected to consume 220 million ounces in 2026. That's up from 65 million just 5 years ago. By 2030, if current growth trajectories hold, solar panels will require 450 million ounces annually. We're not talking about discretionary industrial uses that can be substituted away when prices rise. We're talking about mission-critical components in the energy transition that every developed nation has committed to pursuing. This creates something that didn't exist during those previous crashes, a structural floor under prices based on genuine growing industrial consumption that won't disappear just because speculators get flushed out. The question is whether that floor holds during extreme mechanical selling pressure, or whether short-term forced liquidation overwhelms even strong fundamentals. Now let's talk about the elephant in the trading room. The Bloomberg Commodity Index rebalancing that starts January 8th. JP Morgan's commodity strategy team, led by analysts who've been tracking this sector for decades, published a detailed breakdown on December 12th that should be required reading for anyone holding silver exposure. The report explicitly quantifies what's about to hit the market, and the numbers are staggering. According to JP Morgan's analysis, silver's weighting in the Bloomberg Commodity Index must drop from 9% down to 3.93% during the January rebalancing window. That's not a suggestion. That's a mathematical requirement based on the index methodology. Passive funds tracking this index, and we're talking about tens of billions in assets, must mechanically reduce their silver futures holdings to match that new lower weighting. The report estimates this forced selling could amount to $5.2 billion worth of contracts, representing approximately 13% of aggregate COMEX open interest. Let me put that in context for you. On a typical trading day, COMEX silver futures might see total volume of 70 to 90,000 contracts. This index rebalancing could force the sale of 60 to 80,000 contracts over just 5 trading days between January 8th and 14th. We are essentially compressing a week's worth of normal volume into forced selling that must happen regardless of market conditions, regardless of price impact, regardless of whether it makes any fundamental sense. Here's where it gets even more interesting. While this mechanical selling pressure builds in New York, the physical market in Shanghai is sending us a completely different signal. According to data from the Shanghai Gold Exchange, the premium for physical silver delivery in China has widened to over $8 per ounce above COMEX spot prices. $8. For context, normal premiums between Shanghai and New York typically run between 50 cents and $2, mostly reflecting transportation costs and minor supply-demand imbalances. When that premium blows out to $8, it's not just a pricing anomaly, it is the physical market screaming that paper contracts have lost touch with reality. Chinese buyers are essentially saying, "We don't care what your futures contracts trade at in Chicago. We'll pay $8 over that price because we need actual metal and we know it's worth more than your paper claims." According to commentary from precious metals analysts at Metals Focus, this is the widest Shanghai COMEX spread we've seen since the Hunt Brothers era, and it's persisting even as COMEX prices have fallen 15% from their highs. All right, let's cut through the noise and talk numbers. Because everything we've discussed so far comes down to a simple mathematical reality that will play out across very specific price levels and dates. This isn't about vague predictions or hopeful thinking. This is about mechanical forces colliding with market structure, and the math doesn't care about our opinions. Here's where we stand right now. Silver is trading around $73 per ounce as of January 3rd, down from that record high of $86.62 just days ago. Margin requirements are elevated and staying elevated according to CME's latest updates. Chinese export licensing restrictions went live January 1st. COMEX inventories are sitting at those decade-low levels we discussed. And in 5 days, January 8th, the index rebalancing window opens with $5.2 billion in forced selling that must execute over 5 trading days. Let's do the math on what happens when that selling pressure hits. According to open interest data from the Commodity Futures Trading Commission, total COMEX silver open interest currently sits around $40 billion in notional value. That $5 billion in forced index selling represents roughly 12 to 13% of total open interest, and it has to transact in just 5 days between January 8th and 14th. For comparison, the flash crash in silver back in May 2011 involved forced selling of roughly 8% of open interest, and that sent prices down 17% in 4 days. Now layer in the context. We're not hitting this selling wave from a position of strength with healthy inventories and strong investor confidence. We're hitting it after margin hikes have already triggered billions in liquidations, after China activated export restrictions, after Shanghai premiums widened to historic levels, signaling the physical market doesn't trust paper prices. We're walking into this mechanical selling pressure already wounded, already off balance. The support structure beneath current prices becomes absolutely critical. Technical analysts at Metals Daily have identified the first major support zone at the $68 to $70 range. That's where silver broke out in late 2024 after consolidating for months. If we hold above 70 during this January 8th through 14th selling window, it suggests the physical buying power can absorb the forced liquidation without triggering a deeper cascade. That would be the bullish scenario, painful but controlled, setting up for a spring-loaded reversal once the mechanical pressure lifts. But if we break through 70 decisively, the next logical target sits at that psychologically important $65 level. According to Fibonacci retracement analysis widely used by technical traders, 65 represents a 38% pullback from the highs, right in that zone where corrections typically find support. However, here's what concerns me. If we're testing 65 while index funds are still in their forced selling window, we might not get the usual bounce. The mechanical selling doesn't stop just because we hit a technical support level. It keeps grinding lower until the math says it's done. That brings us to the make or break zone, $48 to $52. This is where silver built its launching pad throughout 2024, where it consolidated for months after breaking out from the COVID-era highs. It's also where, according to cost curve analysis from primary silver miners, a significant portion of global production becomes marginally profitable or unprofitable. The Silver Institute's production cost data shows the all-in sustaining cost for primary silver miners averages around $45 to $50 per ounce, depending on the region and operation. Think about what happens if we test that 48 to 52 zone by January 15th, right as the index rebalancing window closes. Either physical buyers step in aggressively because they know below $50 mine supply starts getting threatened, or we get capitulation. There's no middle ground at that level. It's binary. Here's the capitulation scenario, and I want you to understand this clearly because it's happened before and it could happen again. If silver breaks below $48 decisively, especially if it happens during the peak of forced index selling around January 12th or 13th, we could see a cascade down to the low 40s. Traders hit stop losses. Leveraged positions get liquidated. Panic selling feeds on itself. Suddenly, you're looking at 42, maybe even 40 to 45 if the selling really accelerates. That's what happened to the Hunt brothers in 1980. Once the cascade started, it didn't stop at logical support levels, it blew right through them. But here's the flip side, and this is where the Hunter unique setup of 2026 versus prior crashes becomes crucial. Every dollar that silver falls below 50 increases the urgency for physical buyers who actually need the metal for industrial production. According to supply chain research, solar manufacturers have locked in production schedules through the end of 2026. They can't just pause and wait for better prices. They need consistent silver delivery to meet panel production targets. Same with electronics manufacturers, same with EV producers, same with medical device companies. So if we do get that washout to the low 40s, you're looking at what could be the buying opportunity of the decade for anyone with dry powder and strong hands. The math is simple. Buy physical metal or well-managed mining companies at prices below the cost of production, then wait for the inevitable supply response. Mines don't keep producing at a loss indefinitely. They cut production, they go into care and maintenance, they stop development of new projects. That supply reduction, combined with relentless industrial demand, creates the setup for a squeeze that could make the recent run to $86 look modest. Now, let's talk about the bullish scenario, because this is equally possible and arguably more likely given the physical market dynamics. If silver holds that 68 to 70 support zone through the index rebalancing, if we close on January 14th, still above 68 after absorbing $5 billion in forced selling, that would be an extraordinarily bullish signal. It would prove that physical demand can overwhelm mechanics. Here's where it gets really interesting. According to positioning data from the latest Commitments of Traders report, speculative long positions have been significantly reduced during this correction. A lot of weak hands have already been flushed out by the margin hikes and the 15% pullback. If we've cleaned out the overleveraged speculators and we're still holding support above 70, that means what's left are either physical buyers or very strong hands who understand the long-term fundamentals. The moment that index selling window closes on January 14th, if we're still trading above 70, watch what happens to sentiment. The mechanical pressure that forced all that selling, it just evaporates overnight. The index funds have met their rebalancing requirements. The margin requirements, while elevated, are now known and stable. Chinese export restrictions are priced in. What you're left with is a market where the structural supply deficit and growing industrial demand become the dominant narrative again. If we close above $75 by January 16th, just 2 days after the rebalancing window closes, that would signal to technical traders that the squeeze is back on. According to Fibonacci extension analysis, measured moves from that kind of base building setup point to $95 is the next target, then $118 if momentum really accelerates. And here's why those targets aren't crazy. We still have the same supply deficit, the same Chinese export restrictions, the same depleted COMEX inventories, the same $8 Shanghai premium. None of those fundamental drivers disappeared just because we had a technical correction. Let me give you the critical decision levels to watch over the next 21 days, because these will tell you everything you need to know about which scenario is unfolding. If 70 holds through January 14th, consolidation mode, expect choppy trading, but ultimate continuation higher. If we break through 65 decisively during the selling window, brace for a test of that 48 to 52 major support zone. If 50 fails, blood in the streets, buying opportunity at 42 to 45, but only for those with strong conviction and no leverage. If we close above 75 by January 16th, the squeeze is back on, measured targets at 95, then 118 as physical shortage reasserts dominance over paper manipulation. That January 21st date, exactly 21 days from when we started this countdown, represents the moment when all three mechanical pressures will have fully played out. The margin hikes will be old news. The index rebalancing will be complete. The Chinese export restrictions will have been in effect for 3 weeks, and the market will have adjusted. At that point, we'll know definitively whether this correction was a gift that set up the trade of the decade, or whether it was the first warning sign of a deeper breakdown. Here's what I want you to understand as we close this out. Markets are not random. They're not controlled by shadowy cabals. They're mechanical systems where predictable forces create predictable outcomes when you understand the structure. What we're watching unfold in silver right now is three distinct mechanical forces: margin pressure, export restrictions, and index rebalancing, converging on a market with decade-low inventories and structural supply deficits. The collision of these forces over the next 21 days will create winners and losers, flush out weak hands, and potentially set up one of the most significant precious metals trades of this decade. As Americans, watching our purchasing power erode and our financial markets grow increasingly complex and opaque, understanding these mechanics isn't optional anymore. It's essential. This isn't about getting rich quick on a silver trade. This is about recognizing when systemic pressures create opportunities or dangers that most people miss because they're not paying attention to the machinery underneath. Whether you own silver or not, whether you trade it or just watch from the sidelines, these next 21 days will teach you something important about how modern financial markets really work. The math is playing out in real time. The documents are public. The data is available. All you have to do is watch the price levels I just gave you, and you will see the story unfold exactly as the mechanical forces dictate. Stay sharp, trust the math, not the narratives, and remember, in 21 days, we'll know whether this was the shakeout before the breakout or the warning shot before the collapse. Either way, you're not going in blind anymore. If you made it this far, you're the kind of person who actually wants to understand the machinery instead of just reading headlines. And that is exactly who I make these videos for. Hit that subscribe button so you don't miss the follow-up when January 21st rolls around and we see which scenario played out. And drop a like if this breakdown gave you clarity that the mainstream financial media won't. Now go check those price levels I gave you because the clock just started ticking and silver doesn't care if you're paying attention or not.